Hi, so today topic is what is loan? A loan is a money borrowed from a bank or financial institution. The borrower agrees to pay back the principal amount of the loan plus interest. There are several types of loans including car loans, student loans and home mortgages. Attributes of loans. Although there are several different types of loans which will be discussed below, all loans have several common attributes. Principal, the original amount of the loan or the money borrowed, interest, a percentage of the principal the lender charges the borrower. This money must be paid along with the original amount borrowed. Term, the length of the time it will take for a borrower to repay the original principal and interest completely. A loan that is expected to be repaid with a year or less is considered short term, while anything longer than a year is considered a long term loan. Payment amount, the dollar amount the borrower agrees to repay each month. This payment includes both the principal and interest. If a borrower chooses to pay over the payment amount in a given month, the extra money will directly pay down the interest. The loan process. If someone wants to apply for a loan, there are several important steps to follow. These may vary slightly depending on the type of loan, but in general, those steps are: what is a loan? If you have never received a loan to purchase something, you are certainly in the minority. Loans can be a great thing, but they can also get you into trouble. One of the keys to being financially successful is understanding when loans are a good solution for your situation. Loans are never a good idea if you can't afford to pay them back in the required time frame. Let's explore what a loan is and find out some of common ways to borrow money. A loan is when you receive money from a friend, bank, or financial institution in exchange for future repayment of the principal plus interest. The principal is the amount you borrowed, and the interest is the amount charged for receiving the loan. Since lenders are taking a risk that you may not repay the loan, they have to offset that risk by charging a fee known as interest. Loans typically are secured or unsecured. A secured loan involves pledging an asset such as a car, boat, or house as collateral for the loan. If the borrower defaults or does not pay back the loan, the lender takes possession of the asset. An unsecured loan option is preferred but not as common. If the borrower does not pay back the unsecured loan, the lender does not have the right to take anything in return. Types of loans. There are many types of loans such as personal loans, car loans, and student loans. Even credit cards are considered a type of loan. Generally, they are classified into a few categories: secured loans and unsecured loans. In a secured loan, the borrower must offer some collateral and asset that the lender may seize. If the borrower fails to make a payment, a home deed is a common form of collateral. Secured loans are usually for a large amount of money. Car loans and home mortgages are common examples of secured loans. Simple and compound interest. Simple interest is the interest calculated on the principal amount only. A simple interest loan will cost the borrower less in the long run. Simple loans are established with equal monthly payments, with a greater portion of the payment paying the interest first and then paying the principal balance. Paying above the established monthly rate, if possible, helps to pay principal and repay the loan quicker. Compound interest is calculated on the principal interest as well as any previously accumulated interest. In other words, you pay interest on the interest. Compound interest can add up quickly if the borrower does not keep up with their payments.